Hello everyone and welcome to the Journal Entry Series. Today we're going to look at landlord accounting for rental income. We're going to look at a couple of cash basis entries and then straight line rent. Before we begin, we're going to go over a couple of assumptions throughout all of our journal entries. So in this scenario, we have a fitness franchise who has a 10-year franchise agreement and they're looking for a 10-year lease to match that franchise agreement. So they have 120 months of their lease agreement. They're asking for 36 months or 3 years of free rent. Their beginning base rent will be $20,000 a month. There'll be annual increases of 2%, and their current CAM charges are $2,500 for the first year, and those will reset after each year's actuals. We'll move over to QuickBooks, and we're going to start with cash basis. Okay, so the cash basis entry, the first method you could use, which would be simply the revenue when you receive the check. That's a very straightforward journal entry everybody should be familiar with. You would debit your cash account for $20,000. You would set up your description, your tenant. We'll actually add a new tenant for this. We'll call them Universal Gym, I think was the name we used. Okay. And for this exercise, they will be at Plaza number 2, Unit 1, and that will be retail space. Okay, our credit goes to our rental income. Okay, and that is it for this first journal entry. That's it for this first journal entry. We'll save that, and as always, we'll see how it affects the financial reports. Okay, reports, standard. The first financial statement we'll look at is our profit and loss statement. Again, just for speed, we'll just pick all dates. We would pick the month or the year we're looking at if doing this in the real world. And here we see rental income of $20,000, net income of $20,000. Going back to our reports, we'll take a look at the balance sheet. Again, just quickly selecting all dates. And we have $20,000 of cash, $20,000 of retained earnings. And finally, taking a look at the cash flow statement, we see net income of $20,000. Okay, going back into our journal entry, the next scenario we'll look at is if we bill them prior to the first of the month and we give them several days to make payment. Just so we could see the net impact on the financials, we'll delete this journal entry. And just as an aside, in the real world, I never recommend deleting journal entries. It's better to make correcting entries. It's always good to see a history of what happened. Large GL systems that major companies use won't allow you to delete. QuickBooks obviously will, but it's a good idea to just make a correcting entry. Okay, going back to our journal entry. We this time would debit our accounts receivable. We have our accounts receivable. We have $20,000 for the rent. We make our description. We select our tenant, select the property, and we recognize our revenue. Okay, and same parameters. Save that, and we'll go back to our financial statements, starting with P&L. We should see the same exact P&L as if we'd received the cash in the first transaction, and we do rental income of $20,000. We go to the balance sheet. Okay, the difference here is we won't see cash, we'll see an accounts receivable, and the retained earnings will stay the same. So we have our $20,000 of accounts receivable and our retained earnings of $20,000. And on the cash flow statement, we should not see anything. We have our net income and our reconciling item of accounts receivable. Again, we have a video on how to read financial statements, which will be very helpful in understanding the cash flow statement, especially the reconciling items. And we have net cash flow of 0 for the month. Okay, to complete this example out, we're going to make one more journal entry upon receipt of the check. Bank feed, and you would classify it, but we're going to just show you through a manual journal entry. So we're going to have received a cash check. Okay. And that check was for $20,000. We deposited it in the bank. And we are going to clear our accounts receivable. Complete that. And now we should get to the same situation, same place we were in the first journal entry. So the P&L should look the same. We should see $20,000 of revenue, $20,000 of net income, which we do. Balance sheet now should show cash of $20,000 and no longer an accounts receivable. And there we see our cash of $20,000. The accounts receivable has been cleared, and our net income is $20,000. And finally, to the cash flow statement. Again, it should look like the first entry we ran. And there we have $20,000 from net income. Okay. And we'll clear these journal entries. And then we'll get to the fun part, the straight line rent, which is going to be a lot more involved, but is the proper way to do it. That is US GAAP, and you'll find that in both ASC 606 and 842. All your large corporations will do it this way. Okay, and let's delete this line. I think got one more journal entry to delete. Okay, so going back to our assumptions, what happens under US GAAP is we need to match the revenue and the expenses over the life of the contract evenly. So while rent in year 1 is $20,000 and in year 2 it's $20,400, we need to take an average of that rent. So what we do is we're going to collect it for 9 months since we're giving 3 months of free rent. Total rent collected during year 1 is $180,000. Following this chart, you could see all the yearly rent income equaling $2.567 million. That's going to be earned evenly, not over the 117 months of actual rent collections, but over the contract term of 120 months. So the revenue is going to be $21,399 per month, but we're only going to bill what the contract allows. That's the $20,000 in year 1, escalating by 2% a year through year 10. So what you have is a situation where the amount you're billing is different than the amount you're recognizing in revenue. That temporary timing difference is called an unbilled receivable. The amount we're billing the tenant is our accounts receivable. We want to keep that with only the amount billed so we have proper aging. The unbilled receivable will not be an accounts receivable. It'll be an other receivable, again, because we don't want it to show in our aging report. And then, of course, we'll bill for CAM charges. So we'll start by doing 2 examples. We're going to do the first journal entry, assuming the start of the loan, and then we're going to do one with actual accounts receivable. All right, and finally, we're going to make our straight line entry. All right, this has a lot of moving pieces, so we're going to take our time. So we go into our journal entries, and the first thing we need to look at is what do we have to bill the customer for in this month versus what do we need to recognize. Okay, so the first thing we have to do is we have to debit our accounts receivable, not for rent because we're not billing the tenant, but for the CAM charge. So CAM charges are going to be different than rent. They're going to be billed every month for that because we incur real costs. Okay, we're going to have to set up the accounts receivable, so we'll skip the description for speed. We'll put in the name for the accounts receivable, and we'll skip the property in class. Okay. Our next debit will be for the unbilled receivable. That's going to be $21,399. Okay. Then we have our reimbursable income for CAM. Remember, CAM is a pass-through. We're not going to make a profit off it, so we call it reimbursable income. And then we have our rental income of $21,399. We're going to save that. Again, it's giving us a warning. That's fine. We know we're skipping the property in the class. Okay, we're going to go to our financial statements. We're going to start with the P&L. And again, we'll just quickly run it all dates. Okay, so here we see we have the $21,399 of rental income. We have $2,500 of CAM, and we have our gross profit of $23,899, the sum of the two, which is our operating income. Okay, we'll go to the balance sheet. Okay, on the balance sheet, you're going to see accounts receivable of $2,500. We want that in accounts receivable because we want to make sure we have accurate aging and know what we're expecting within the next 30 days from this tenant. The unbilled receivable is in other receivables because we do not want it to affect our aging. And we have our net income. Going to our cash flow statement, here we see $23,899 of net income, and then two reconciling items for the accounts receivable and the other receivables. Okay, again, check out our video on cash flow statements where we break down how to read these reconciling items. Okay, going back to the journal entries, we are now going to receive payment for the CAM charges. So that's going to be a debit to cash for $2,500. And a credit to the accounts receivable for $2,500. We'll just quickly select our tenant and we'll complete that. Okay, looking at our financial statements. Okay, that transaction was balance sheet only, so our P&L will not have changed. We run that report, and we still have our same revenue and net income. Okay, going to the balance sheet, here we are going to see some activity. And we're now going to see cash of $2,500. We're going to see the accounts receivable cleared and the unbilled receivable staying in place. And we have our net income. Okay, going to our cash flow statement. Okay, here we see our net income of almost $24,000. And we see the one reconciling item, the unbilled receivable, showing net cash flow in of $2,500. Okay, next we're going to make a journal entry for a month in which we are expecting rent. So we're going to start with our accounts receivable. Just to show you the detail, I'm going to do two accounts receivable. You could combine the two, but we're going to do two for illustrative purposes. So the first is going to be your $20,000 for your rent. Okay, again, use your description, property, and class, but we do need to select the tenant for the receivable. We're then going to have another accounts receivable. This one's going to be for $2,500. And that's going to be for the CAM. So this would be a good chance to use your descriptions. Straight line rent or rent received, billed rent might be a good description. CAM might be a good description. Then we're going to have the unbilled receivable. That's going to be $1,399. And now we have our two pieces of income. And this number right here should look familiar from the last journal entry. Okay, we have our rent income. And that's going to be $21,399. And we have a reimbursable income for CAM. That's going to be $2,500. Okay, we're going to save and close that. And one quick thing, just for illustrative purposes, let's just make this a different month. Okay, we're making this journal entry in the future. Okay. I'm going to go to all dates. And now we see net income of $47,798. Okay, now we're going to look at the impact on our financial statements. We're going to start with the profit and loss. We're going to look at all dates. And here we see rental income of $42,798, reimbursable CAM of $5,000, and a net operating income of $47,798. Okay, next we're going to look at the balance sheet. Okay, running that quickly, all dates. We're going to see cash on hand of $2,500. That's the CAM we collected last month. We have an accounts receivable for the $20,000 of rent due this month and the $2,500 of new CAM. Our unbilled receivable increased from $21,399 to $22,798. Okay, because we're increasing it now by just $1,399. And we have our net income of $47,798. And finally, we're going to look at the cash flow statement. And we have our net income, we have our unbilled receivable, which is our reconciling item, and we've collected $2,500. All right, let's collect this month's rent. So we're going to go back to making a journal entry. Okay, cash. Okay, so we know we've collected $2,500 plus the rent. Okay, and again, we would combine this normally, but just for illustrative purposes, we'll just break out each component. So we know we're going to have $20,000 we received from the rent payment, and we have $2,500 we've received from CAM. Again, you could easily combine those two. And then we're going to clear our accounts receivable for $22,500. We'll save that. And we got a warning here, so it's good that I messed this up. You are using accounts receivable. You must choose a customer in the field name. So it's great that that gives you a warning. And we'll go into that, and we'll do Universal Gym. Save and close, and yes. Okay, going back to the financial statements. We'll start with the P&L. Okay, as expected, there'll be no change here. Okay, everything is the same as last time we ran it. The balance sheet will look different. All right, our company is starting to get some cash. Okay, so now we have $25,000 of cash. That's $20,000 from the 1 month of rent we collected and the 2 months of CAM charges. And we have an unbilled receivable of $22,798. And finally, we'll look at our cash flow statement. Okay, we have our net income of $24,000, and we have our reconciling item of the unbilled receivables. And oh, I'm sorry, we did a journal entry in advance. So let's go to all dates. We have a net income of $47,798, a reconciling item of the unbilled receivable, and our cash now matches at $25,000. Okay, I do want to go back to the schedule just to show you how this works. So again, this schedule is critical in setting up a straight line rent table. It's also, you might hear it called a FASB 13 schedule. So basically, the unbilled receivable is the difference between the rent revenue and the cash collected in any given month, assuming cash is collected every month. So we're not expecting any cash in the first month, second month, or third month. So the unbilled receivable grows. In the fourth month, we're sending out a bill for $20,000. Remember, we're earning this in a straight line, but we're billing and collecting rent based on the terms of the contract. So if we were to go all the way to the end of the contract, this will net to zero with our accounts receivable and our revenue tying out. I do want to show you one other tax pro tip that's very useful. So what we're going to do is we're going to go back to QuickBooks, okay, and we're going to go to our journal entries. I'm going to just delete the last two entries to illustrate this point. And this will be an extreme example, but it will help very clearly illustrate why you have to understand temporary and permanent timing differences between your book and your tax returns. Okay, so deleting that. Okay, and we'll go back to our reports. And here are our reports, the end reports. Okay, somebody who wasn't familiar with this could look at a P&L and think, I have income of $21,399 from rent. Don't worry about this reimbursable CAM because there should be an offsetting expense if we were going to make that entry. So this income would appear to be taxable. The problem is taxpayers in almost all circumstances are cash basis, and we have not received any cash yet. So the tip is this: always make sure that you look at your balance statement and you look at two items. They're going to help give you clues. And those are your receivables. So receivables are money that was earned on the P&L, but you've not received the cash for. So this unbilled receivable tells us we've not received any of the cash yet. So in this very simplified example, there wouldn't be any tax consequence whatsoever. Conversely, if you had received cash but not recorded the income, the opposite would be true. You could have a P&L where you report zero taxable income when in fact it should be the cash component. So it's a really good habit to get into, to always look at your earnings and then your receivables and make sure you reconcile those. If you're doing taxes or if you're working with a tax preparer for your client, make sure you communicate that. All right, everybody, I hope this was helpful. If you have any questions or comments, please leave them below. If there's any journal entries you'd like to see in the future, please let me know. And as always, have a great day. Bye.